You are entering an investing state of mind the system doesn't want you in. The truth. You want answers? Michael Covel has them on the trend-following radio network. And now, reaching over 130 countries and territories, Michael Covel.
A two-part episode today. Two entirely separate interviews. Back to back. Definitely a trend-following episode. First, today, Scot Billington of Covenant Capital. Trend-following CTA, decade-plus track record. Very, very meat and potatoes trend-following conversation today. Scott and I just get into the nitty-gritty. And it's really cool. Scott's September 2014 trend-following performance. Definitely will find that interesting. Second on the show today, back for the second time, is John Borman, author, Twitter extraordinaire. I don't know, Twitter extraordinaire guy. I don't know what one should be called, but I want as many followers as John has. He has a ton. John is a recently new indoctrinated RIA. So beyond blogger, guy on Twitter, now RIA. My conversation with John is about trend following as well, but we also dovetail into several life issues that kind of go around the notion of trend following. So my first conversation with Scott today is really trend following trading. My second conversation with John today is trend following and life. Also some trading too, but trend following and life. Two separate interviews back to back. I hope you enjoy. Hey, Scott, how are you?
I'm great, Michael. How are you?
Not too bad. I was just thinking, I think you and I have been trying to schedule this for about a year, haven't we?
Well, I appreciate you finally fitting me into your busy schedule.
Well, likewise, I know you're a busy guy too. So we finally, but I think it's good time now because there's all kinds of interesting things happening at your firm. Of course, I don't want to put you in a position of not having the disclaimer there to talk about a positive month of performance because, of course, as a trend following trader, you're going to have down months. So there you go, Mr. and Mrs. Regulator. But that doesn't obscure the fact that apparently your optimal fund performance for September of 2014 was 84.68%. Scott, that's a big number.
Yeah, it is. It'd be hard to argue that it wasn't.
That's a really big number. That's kind of like old school trend following. That's the stuff that everyone says they don't want anymore until they get it. When everyone goes, God, I'm really glad I got that. Right?
What they tend to not like is what comes with that.
Well, this is true. This is true. I mean, as I try to give the disclaimer, we're not attempting to say you're making 84% every month. And I'm guessing that's one of your biggest months ever for any of your programs.
I do think that's the biggest month we've ever had in a program. Yes.
Yeah.
But the optimal is set up with that in mind.
Yeah. Well, that's cool, though. I mean, so that's interesting. You know, in a world where so many people are looking for minimal drawdowns and they want to avoid all risk, even though risk is required to get the reward, it's interesting that you have found a collection of clients that still want to make money.
Well, I'll actually take you one farther on that.
They want to make a lot of money.
They do, but I'll go this far. The more that I've thought about it, the more I've come to the belief that the optimal is actually the least risky way to trade it.
Okay, explain.
Well, I think about it this way. If I have a program with low drawdowns and low volatility, what's going to tend to accompany that is low returns. And so if I'm going to have low returns, then I'm going to need to invest a lot in that program to either have that much punch in my portfolio or to make the amount of money that I need to or would like to make. Does that make sense?
Absolutely.
And so the way I look at it is that regardless of what the past performance is, regardless of what you think, the amount you have at risk is the amount that you invest. And so, and I would go one step further and I would say real risk is the difference between anticipated worse loss and realized worse loss. If the future performance of every investment stayed within the boundaries of our models, no one would ever really have a problem. Something might lose money, but it would never lose more than we, quote unquote, thought it could lose. However, as we know, that isn't always the case. And so when I'm having to make these large investments in lower or low volatility or low return programs, I leave myself open for huge amounts of unanticipated loss. That makes sense?
Absolutely. Absolutely. You're saying allocate less and put it in a more risky type strategy.
Well, rather than risky, I would say a higher return program. Because here's the thing. Let's say I wanted $10 million worth of punch of Covenant Capital's original program or of trend following. And your standard trend following model, it's kind of trying to make 10 to 15% with a 15 to 20% worse drawdown. If I invest in the optimal, instead of putting up 10 million or opening a $10 million account, I could get that punch for probably 2 million. And depending on how long I let it run or how I reinvested the profits, maybe as little as 1 million. So what's going to happen with those two investments? If I've invested 2 and you've invested 10, you're going to have a hard time convincing me that I have more money at risk. But in a higher return program with the power of compounding, I have a higher ultimate upside.
Well, this must have been the case though for many decades there, and we could throw their names out there, but I can think of a gentleman down there in South Florida, in Stewart. He clearly has had a similar belief to you for probably 40 plus years.
Yeah, I certainly this is probably nothing new. What we've tried to do with the optimal, and again, the key is when I say high return, I mean, we're probably targeting or anticipating or hoping, targeting is probably the fairest word, for north of 75% a year.
I mean, that in of itself in 2014 is odd.
It is completely odd, which is another reason that we like it, is that I think it's fairly unique in the industry. But if you think about it, even, institutions basically have, I'm going to use the word dumbed down returns, but I don't mean that in a critical manner, but they have demanded product that was very low volatility.
Right.
And because of that, to get a large allocation, particularly managers that have been successful, have tended to diminish their volatility as their business has progressed. I think if you took any CTA with a 15-year track record, their last 3 years were probably less volatile than their first 3 years.
Yeah, but you guys have been at this for
15.
Okay, so you've been at this for 15, and you're introducing a very high return program. So it hasn't changed you.
Well, I wouldn't be so grand, but we think there's a place in the market for this kind of program. Number one, for an individual investor, we think having something in your portfolio that could hit a home run makes sense. In fact, we had a little something up on our blog where one of our guys ran a quick study on what it looks like if you're doing your standard $5,000 a year IRA contribution. If you took just the first year and only the first year and put it in something with potentially very high returns, even if it doesn't work, it doesn't hurt your net outcome to being 60 years old very much at all. And if it does work, it can completely change your financial situation, within a 20-year time frame. So I think for an individual, having 1 or 2%, maybe, 5%, making a $10,000, $20,000 investment in something that can hit a home run makes sense. I think for an institution, if you look at your allocation and you take what you just said, which is, I'm going to make smaller investments. I'm going to invest in the same things I was going to invest in. My net portfolio is going to try to look the same. But instead of putting 10 million in a typical trend follower, I do 2 million in Covenant. Number one, I just cut my fees by 80%. Number two, I have increased my own liquidity by 80%. I have less maximum downside. And over a 5 or 10 year period, I actually have more upside. So if you look down and think about the check boxes for an investment, lower net risk, higher potential return, increased liquidity, lower fees. That seems like a pretty good do to me.
Indeed. Let me ask one strategy question. Then I want to go back in time and get back to where you started, and then we'll work forward. Is all of your trend following trading predicated on a weekly system?
I don't know that I would define it necessarily as a weekly system, but so much as we're attempting to hold winners for a year or more. So our model is going to be built around catching swings of that, or, catching trends of that size. And so then to catch trends of that size, we're going to naturally need to set up our entry and exit triggers so that smaller, or, what might seem like a big move in a week does not necessarily get us to get in or out of a trade.
I guess what I want to clarify, though, are you using weekly closing prices as one of your triggers?
No. The outcome is going to be, the time frame that we're going to work on is going to be more weekly-ish in nature.
Okay. Makes sense. Let me go back in time a little bit. So
Sure.
What was your inspiration? What were you doing as a young guy? What was the inspiration that got you into this systematic trend following space? And I'm curious if you could start even maybe in your teens or college years, and then perhaps give a storyline as to how you were awakened to the specific strategy of trend following.
Well, as a youth, my mom tells a funny story. I think I was homesick from school when I was 10 or 11 years old, maybe 9, in that age. And I was homesick from school, and I asked her to go to the library and bring home every book on gambling that she could find.
Hold on. How old were you?
10 or 11, maybe.
You wanted every book on gambling?
Yes.
Okay.
And I remember sitting in bed trying to design a way to beat a roulette wheel when I was at that age.
When did you figure out the odds were against you?
That wasn't going to happen, is what I figured out. But it wasn't without a genuine effort. I can promise you that. Fast forward from age 10 to age 25 or 6, I worked in the futures department as a commercial, more or less commercial, hedging broker. And I worked under a guy that had a hedging book and did some discretionary trading, for some clients around that, but commission-based standard brokerage. I remember thinking that if you couldn't make money making these trades, there really wasn't much else you could offer. And that the people attempted to kind of dance around things, I give this information and blah, blah, blah. And I kind of figured, at the end of the day, you've got to be able to make a profit. And the idea of being a CTA was something that appealed to me. And there were two things that I recall pretty vividly, anecdotes. The first is that I thought to myself, all right, someone has to make money. Who is it? Who's doing already what I want to do? And I'd read the Market Wizard books and that kind of thing. And I remember I took the Barclays 10-year track record, or ranking. And of the top 25, I want to say it was like 18 of them described themselves as long-term trend follow. And that obviously left I figured, making money trading probably isn't very easy. And there obviously are different ways you can do it. But if 18 of the top 25 do it this one way, that's probably at least where I ought to start looking. And the second thing I pretty vividly remember is we would have clients and I would look through their statements at the end of the year and they would show how much money they made, et cetera. I remember one client who was I would consider a very smart one and a pretty good trader. And, let's say this year he'd lost $50,000. And I thought, oh, well, so-and-so didn't do very well. He lost 50 grand. And I looked over in another column and I noticed he'd paid us 80,000 in commission. That doesn't even include the bid-ask spreads he paid down on the floor. And I thought to myself, he really made brilliant decisions when to get in and out of the market. He just made them too often because there's no way he could be so good at getting in and out of the market to overcome that 85,000 in commission and probably triple that in bid-ask spread. And that left has always been a cornerstone of what we do is minimizing that transaction cost. And so, armed with those two little anecdotes, I set off and started trying to develop a trading model.
Did you have any further mentoring, or did you literally sit down and say, okay, it's time to start modeling, it's time to start testing and just crunching it out? I mean, were you using a piece of software by hand? What were you doing?
Well, not only did I just start trying to crunch it out, I did it all by hand, which was arduous, obviously. However, I do think the benefit of that was that eliminated any data mining or any curve fitting, because it probably took me, I would say, 150 hours to test one thing. I can't prove this, but I do think that my going through, I would say, okay, I entered the chart or I entered the trade on this day. I'd write down the price, and then I'd say, okay, I'm going to roll this day out of every contract, whatever it was. But I did flip through every single contract across all the markets and all the time that I had, and I probably did it, 15 different times. I think in looking at all those and watching those trades unfold, some of the things that we've later done, those ideas came from that arduous process.
One of the things I thought was interesting in your presentations that I was going through is you quote somebody from 1519, a very famous guy that knew something about art and math, Leonardo da Vinci. And you quote him and you say, simplicity is the ultimate sophistication. There are many, many peers, associates out there, competitors that have trend following performance that's going to look very similar in terms of the ups and downs, but they're talking about quite a bit more in terms of sophistication. Whereas I'm getting the impression from your work so far, your track record over the last 15 years, you like simplicity, and simplicity is not for lack of sophistication.
Well, I think one thing you always have to remember when people are talking is I don't know how much is marketing and how much is trading reality. So I would first think about that. And you've talked to a lot of people, and I'd be interested in your opinion on that.
I think ultimately when you look at a track record, you look at the black ink and you look at the red ink, and you can compare managers pretty quickly. I remember doing that for the first time in the mid-90s, and I thought that was such an eye-opener because those trend following traders that you described in Barclays, I was looking at the same ones and I was like, wow, they got the same month's red ink and the same month's black ink. Some of them are making twice as much when they have the up months, so you could start to think about leverage and whatnot like that. And even today, I don't know how much that's changed. And I'm sure also, I think the audience should probably keep in mind that some people might want to disguise the true nature of their trend following systems, even down to the performance level, not making the performance look traditionally trend following. Just a theory of mine.
That would be an interesting one. I would tend to agree.
It's a competitive world.
Yeah, I don't want to get off on a tangent, but at the end of the day, people hate trend follow investors. It's not what they learned in business school. I spent a lot of money on that education, and that education told me this shouldn't work. It does not have a narrative that goes along well with it on a trade by trade basis, and that hurts us in the narrative. It doesn't give a trend follower the narrative bias, and people don't like mechanical things. They hesitate. It'll be interesting when the first self-driving cars come out. The computer can drive a car thousands of times better than a human. It doesn't make mistakes. It doesn't get annoyed by the kids, it doesn't fall asleep. But we'll hesitate to use them, and they'll all have manual overrides, in case, quote unquote, the computer goes on the fritz. And so in general, people hate trend following, and investors don't like it. It's a very competitive, crowded space. And so, yeah, I would concur. I think a lot of groups spend a lot of time talking about how all their other stuff they do than trend. And I know this, we don't do anything. We don't do anything other than trend, period, paragraph. And at the end of the day, our performance looks a lot like a lot of those other groups, and it oftentimes looks a lot like it, but is a little bit better than it. And I wonder if in the attempt to dazzle with their short-term mean reverting model overlays, they don't end up, much ado about nothing.
Now, I've seen you make the comment, though, too, from your perspective, trend following, one of the most repeatable or the most repeatable trading strategy that you are aware of.
Well, I think if you look out there, I had a guy last week got mad at me. He thought value investing was better. And I said, okay. And I'm not saying that it's better, but I think when you talk about repeatable, teachable, it would be very difficult to find something that has been as repeatable as trend following. Some of those high frequency trading strategies obviously are pretty repeatable. And this is outside the world of market making, is a very, very profitable, repeatable, if you want to call that a strategy. U.S. or Western economy value stock investing has been successful over a long period, and it's been pretty repeatable, it seems like. But trend following's right up there, and I think if you look at science, it's all about a peer review. I ran a test, I ran an experiment. Can my peers run the same experiment and get the same results? And trend following, if you look at it now, there are a lot of groups trying to say that trend following is just beta. It's this profitable thing that exists, but anybody can capture it. So, we have an index kind of beta program trying to capture it.
Your perspective on that?
Well, I think that there's a market edge or a market anomaly that trend following offers. If you look at the markets and figure, they're pretty efficient at pricing news and other things, but like anything else, there's a couple, whether you want to call it an anomaly or an inefficiency or something like that. There are a few things that are not priced accurately, and trend following captures one or several of those things. And so there is an amount of edge that exists in the strategy. And then from there, I would say the different traders are trying to be as efficient as possible in capturing that edge. Capturing as much of it as they can, then you'd have to bring a risk element into that. And so keeping the risk within an acceptable bounds and capturing as much of that edge as possible.
Let me shift into something that I caught in one of your presentations, talking about the efficient markets hypothesis. Mm-hmm. And this is from your presentation. It's normal statistics suggest that a one-day price move outside of plus or minus 5% in the Dow would occur once every 26.4 years. It's actually happened 129 times in the last 80 years. And you go on to make the point that this phenomena has been prevalent in all freely traded markets on all time frames. Why don't you discuss that? That really gets at the root of perhaps one of the great sources of where your return is coming from, is that so much of the world actually still believes, regardless of how many Nobel Prizes are handed out, still believes in the idea of efficient markets, and that you, Scott, can't do what you do, regardless of that performance number that I read at the beginning of this podcast. That's all an illusion. It doesn't really exist.
Well, that goes back to why people hate trend following, right? The efficient market that they learned about, and they spent $200,000 on a business school, and they learned these things, and guys won Nobel Prizes from them, smart guys. But basically, the distribution of market returns is non-normal. It has a peak well above the bell curve, and more importantly, it has tails that are extraordinarily fat. Now, that isn't to say that they're frequent, but like you said, and I missed all the, specific, but, things that are supposed to happen once every 1,000 years happen about once every 50 years. The spread is even greater than that. And so if one of the things I have long thought is, I think a lot of, if not all of, the edge in trend following, if you think about a fat tail, and what that means is there's a large 3+ standard deviation from the mean move. And particularly if you couple it with the high peak, meaning that there are more moves within half a deviation than there should be as well. Think about a trend follower getting in a market and putting a stop somewhere outside that high peak and profiting from these 5 deviation moves. That's probably going to be the basis of a profitable method.
I've also seen you make the comment that the only prediction you'll make is that trends will continue to emerge as a function of the marketplace. I mean, that is the one thing of being a trend follower. You have to be comfortable with the idea, the expectation, the hope that the way the markets are structured and the way the participants play ball, that trends will continue to emerge. But that seems like a fairly safe bet, because if they didn't emerge, I think everything would just go sideways, and that would be very unusual and very odd. I think if just the audience thinks about that for a moment, how could everything go sideways?
If you think about the cornerstone of trend following and the cornerstone of the fat tail move, what we're really saying is that the real prediction I'll make is that these markets are going to go farther than anybody right now thinks they possibly could. And they're going to go higher and lower and in correlations and in combinations that right now might not make a lot of sense. And so that's kind of the backbone of what a trend following method is. And so for us then to sit there and try to predict where something's going to end or where something's going to go, I'll leave that. There are other people that attempt to do that, and some of them do it pretty well and can make some money, and that's great. We're not trying to be all things to all people. We have a persistent, identifiable, capturable market anomaly that we think that we have been able to exploit for the last 15 years, and we think we'll be able to exploit for the next 15 years.
Hey, talk about basing your shop out of Nashville, not being in one of the financial hubs. I know many other trend following traders have elected to be in unique locations as well. So you're not necessarily original there, but I'm curious your experience and being in a smaller mid-sized city to set up shop versus going to a New York City or a London. You clearly could be anywhere you want, but you choose Nashville.
Well, we lived in Nashville when we founded the company, so there wasn't really any grand design. Ultimately, that has made building a business quite a bit more difficult. We definitely would be managing more money now if we had picked up and moved to, there's a high likelihood we would be managing more money now if we picked up and moved to New York the first day we founded the firm.
Well, what drives you? You could go there today. So what drives you? Clearly you're having a lot of success now, but what drives you to stay? Is it almost like an internal bet? You're like, well, you know what? We've done pretty good so far. We've done pretty good so far. We're going to stay in Nashville and turn it into a multi-billion-dollar fund. What drives you?
I don't know that we're ever going to be a multi-billion-dollar fund, and we stay in Nashville because that's, now I live outside of Chicago, so we have 2 offices, one in Chicago and one in Nashville. But the headquarters stays in Nashville because that's where we live, and that's where my business partner's family is, and that's where his life is. And the point of having a business is for you to use the business to enhance your own existence, not the business to use you. And so if we manage $500 million instead of $1 billion, we're going to still do okay. Our goal has never been to be the biggest manager. It's always been to be the best manager. Those two things don't always correlate. Some of the very big managers are quite good. Some really aren't that great.
How do you are you defining best as biggest returns?
Oh, I think you have to have some method of risk adjustment to that. I'm not a big fan of the standard volatility risk adjustment, but I think when you look at the returns, there has to be some measure of whether it's downside volatility or worst drawdown. One we like to use a lot when we're testing things is average drawdown. So, over a given time frame, we might say, over 10 years, let's look at the average of the worst five worst drawdowns or something like that. So we can get an idea of, in a typical year, in a typical period, what kind of losses do you have to endure to get those gains? So I think if you're looking at some kind of return, you have to have some risk divisor in there.
Now, for your portfolios, I think the number is 44 markets.
We trade 44 different markets, yeah.
Each market traded equally in the model in terms of risk budgeting. Why don't you explain that to the audience?
We're going to try to take the same amount of risk on every trade. We don't try to predict when a trend. I don't think that there's any more likelihood of a trend in cocoa than a trend in Japanese yen. So when a trade comes up, we feel like it has the same expected value, and so we want to risk the same amount on every trade. And so unless we're constrained by liquidity, that's what we're going to do.
Being a little bit smaller shop than some of these large European CTAs, do you find, though, that people still will have that question when they see what your strategy is? And they're like, hold on, cocoa, platinum, gold, indices, how do you have the expertise to trade all these things? Do you still find yourself having to give that baseline trend following explanation to get them to understand that you're not a fundamental expert in all these markets?
Not too often. I think most people are pretty familiar with what a trend follower does and what a more diversified trader does. And if they are asking that question, then we haven't done a very good job of explaining what it is that we do. What we are saying is markets have an abnormal price distribution. And if that is your premise, then it is not logical that you wouldn't trade all different markets. So we're not just saying the stock market or the bond market or this market or that one has this abnormal feature. We're really saying it's present in all markets. So once that's your premise, I think it makes sense to trade a lot of different markets.
I've seen you explain a barbell strategy. Explain it to me. Explain it to the audience. The idea of a barbell strategy. Obviously, it's going to be trend following based, but explain that to the audience.
Well, it doesn't even have to be trend following based, and this gets back to more what I was talking about with the optimal program. And I've seen this other places, but the idea is that when you make your investments, whatever they may be, is that you would have, and barbell may not be the right word because it's going to be a very an unbalanced barbell, but that you would basically avoid the things with quote unquote medium risk. My suggestion would be that the things with medium risk really have more risk than they've shown or than you might think. But basically you would take the gross majority of your money and put it in things that were very, very safe. And then you would take some much smaller percent of your money and put it in things that were very, very aggressive. And so that I would control my risk through my allocation sizes. And, I would really look for, a lot of people, you'll see them, they say, all we try to do is hit singles and doubles. We're not, we're going to, and I would really say is that with my money, I either don't go to bat. Most of my money doesn't go to bat, and the little bit that does go to bat tries to hit a grand slam home run. And I think ultimately that is a strategy that's going to, as I talked about with the optimal, not only be safer, but over a long time frame is going to potentially have the highest returns.
I think it's how many of the great names in the trend following space originally started. It was with that style of thinking. And I think once perhaps, and the other way is not necessarily bad either, but I think once pension funds and whatnot wanted to start to make the very large allocations, they didn't want to see the big returns and perhaps the steeper drawdowns. But It's two ways to do things. And I think what's interesting about what you're doing is at least you're saying, hey, look, here's that choice that used to be there. Here it is again.
Mm-hmm. Well, and I don't pretend to know. I mean, a pension fund, those, they might have very, very different goals than a individual investor. I mean, number one, any fiduciary is, somebody that is allocating your money and you are going to have different goals. The allocator, at the end of the day, he doesn't want to get fired. And so, as long as he, does on a scale of 1 to 10, as long as he's doing 4.5 out of 10, he's probably not going to get fired.
How many millions of people have their money managed by people whose sole motivation is not to get fired? That doesn't seem like the best motivation to have my retirement money with somebody making decisions just based on whether they get fired. I think you're accurate. You're not the first person to say that.
Ultimately, for most people, they don't have a choice. They're in some kind of public pension plan. They don't get to choose who manages the money. And then, and indirectly, just think about it. If you were some kind of allocator and you made 1%, you're a stockbroker. Anything. The old adage, you never lost a client buying IBM. That shows my age. I suspect that would be Apple now. If you have $1 billion and you're getting even 0.5% on it, that's $5 million a year. If I do great, I don't make any more. And if I do average, I keep making my $5 million. It's only if I do terribly that all of a sudden I make zero. I kind of have a binary outcome. So I don't begrudge that decision. It's a good decision. And it is also isn't totally just in the self-interest. This guy's allocating money and he's thinking, you know what, guy or gal, and he's saying, the first thing I'm going to do is not lose too much. And he's going out and he's looking at a past performance and he's selecting people who haven't had a lot of volatility and haven't had a lot of drawdowns. And it feels very, very safe. It's a very defensible line of thinking. And I can see how it's in vogue. What is interesting is when we talk to people, and if I'm talking to somebody and the optimal comes up and they're a more institutional kind of allocator, they have no interest. Zero. But then I'll say, I'm not talking about your client's money. You're never going to give us any of that. I'm talking about your money.
Then they want to have a conversation.
All of a sudden, the optimal gets a lot more interesting.
Hey, I got one last technical question for you that I'd love for you to explain that I had here in my notes that I want to talk about. With trend following, some of these measurements out there, and you can toss them out there, but some of these measurements, the risk-adjusted performance, often are a little misguided. And one of the ways that I think they're misguided, and I'm sure you probably agree with me, is they somewhat put a negative connotation on upside volatility. Downside volatility, sure, but upside volatility is not such a bad thing. That's par for the course in making money as a trend following trader.
We actually wrote a couple papers on this that are on our website, but I think a lot of it goes back to the stock market. The stock market doesn't ever has not ever had large spike up months. If you look at the option volatilities, when I say stock market, I mean an index, not an individual stock. The call side of that option implied volatilities is flat. And most implied volatilities are a smile, meaning they go up the farther away you get from the money. But the stock market, if you risk adjust by worst drawdown, is going to look a lot worse than if you risk adjust by standard deviation. And so I think some of that flow, that, okay, that's what we're judging the stock market by, let's judge these other people by it. And I would say that standard deviation, upside volatility, using that as in essence a negative, is only good in the amount that it could forecast future downside volatility. So if I had a trader that had only traded a couple years and had a bunch of huge up months, but had never had a big down month, I think volatility would probably be a useful indicator there, because I would be thinking to myself, They just haven't had their bad month yet. Now, I would agree with you wholeheartedly when you get somebody that has had north of a 7-year track record, and particularly somebody that, like trend following. Trend following doesn't try to hide its losses are out there for everybody to see. You took let's say an option selling program. It might make 1% a year or a month every month for 7 years and then lose 60. So in that, what I would say there is that in essence, the real risk of that program is hidden until you've had the big, a market break. Trend following, that doesn't tend to be the case. Our losses are more or less out there for the world to see. And it has a regular ups and downs and drawdowns. And, in our original aggressive program, we always say, look, you can expect a 10 to 15% drawdown every year. Every few years, it's going to be bigger than that. With a trend following program, I think adjusting by standard deviation, because we do tend to have large spikes up, the downs tend to be, they might be larger, they're less than the spikes up. So yeah, the upside volatility crushes our Sharpe ratios and things like that. And that's why I think when you're risk adjusting, you really need to look at
what kind of risk measure are you actually using?
We look at 3 or 4 different things.
But I mean, when you say that about the Sharpe ratio, to the audience out there, you really like to say to yourself, how do you define risk instead of just trusting some particular ratio?
Yeah, I think I'm a much bigger fan of drawdown, of actual realized losses. That has to be, that has to be footnoted by, number one, the track record has to be long enough that there's been a bad losing period. The style of trading, if it is short volatility, if it's something that wins, there's either a frequency winner that wins because they win most of their trades, or there's a magnitude winner who wins because the winners are far bigger than the losers. If I'm a high frequency winner, meaning I win a super high percentage of my trades, that means that my ratio of winner to loser is probably going to be less than 1. And in that case, the realized drawdown may be misleading because I might not have hit a bad period yet. Does that make sense?
Yep, absolutely.
So in that case, I think it's very difficult to risk adjust a return like that. The only metric I would use in that case is I would divide the returns by the average amount at risk. Now, I don't know if you're going to be able to get that out of a trader, but meaning from my current market to my pre-planned exits, how much do I have at risk? And then you can divide the returns by that. I think that's a useful metric. If it's a method that's risk is realized in its past performance, then I think drawdown and worst drawdown and average of the worst X number of drawdowns are more effective than deviations.
Scott, when I have you on again in the future, we're going to have to talk about another big month that you've had, but I also want to break apart a big losing month next time, because you're going to have them. It's par for the course as a trend following trader. But I think it'd be good for the audience. I don't want anybody out there thinking that I was starting this conversation off with a cherry pick. I mean, it was a cherry pick, but
we appreciate cherry picks.
Look, it just happened. So we had to talk about it, after reading every article in the last couple of years about how trend following is dead. I have a trend following trader on my podcast that makes 84% in a month. I want to talk about it. So there.
I will, if I could say one last thing, and it's to your last point, and it goes back to my everybody hates trend following thing. Notice what performance brings in the death of trend following. Now, I don't know what other people did, but I think in the last few years, we I think our original program made 2.5, and a half. And I will grant you that's under our expected return. But that's far from awful. Like, nobody had to mortgage their house because of those losses. They were actually gains. You see what I mean? And I think it's hilarious that the S&P can lose 50% apparently once a decade, and that's a buying opportunity. But if trend following, they were down 5. Oh, they had a 15% drawdown. That means the method doesn't work anymore.
Yeah.
And obviously that has been frustrating for those of us in the business last few years. But I do think it is notable that how quickly whatever, the consensus turns on trend following and is ready to write it off.
Look, I would say, too, for the audience out there, it's worth investigating. Look, none of us can tell you why any particular market is going to move, and that includes the S&P after its massive move since March of 2009. However, it's worth contemplating why a particular strategy works. Why does buy and hold work? Why does trend following work? It's worth contemplating because not all buy and hold strategies work. For example, the Nikkei. So, you got to really think that things can happen and they can go wrong, if you're just betting on a market going up. And that's the cool thing about trend following is trend following adjusts.
I would agree wholeheartedly. Not only that, but it also isn't dependent on a given market. I would say once again, I think you've put it pretty well. And what I try to tell new investors and new prospects is we've done quite well over the past. This is why we anticipate that continuing. However, when you make an investment with us, you need to size your investment appropriately in case the future doesn't look like the past at all. There's some small chance maybe the future is completely different. I would say that that's the case with any investment. But, trend following, particularly because it's been so repeatable, it has as strong an argument, I think, out there that it will provide some form of positive return into whatever anticipated future.
Scott, where can people go to find out more about you and Covenant Capital Management?
CovenantCap.com. I think we're Covenant Cap on Twitter as well. If you look up Covenant Capital, we try to write a lot of things that aren't self-promotional, but are hopefully useful for investors and all across the investing spectrum. We tend to post those on our blog, and we'll talk about, that they're coming out on Twitter. And I think that's probably the best way to learn a little more about how we think and why we do what we do and what the philosophical thought process is behind our firm and our methods.
Scott, my pleasure. Thanks for finally coming on. I mean, not finally coming on. Look, we both had scheduling issues, but I appreciate you coming on. And once again, congratulations on a very cool month of performance for September of 2014.
Thanks a lot for having me, Michael. I hope we can do it again.
Thank you, sir. Take care.